The company gives 2 months credit to its customers and is allowed on average 1 month's credit by trade suppliers. It has an operating cycle of 3 months. Other relevant information: with current ratio of FLG company as given as 1.4, cost of long-term finance of FLG company is given as 11%. Discuss the key factors which determine the level of investment in current assets. Briefly discuss the ways in which factoring can assist in the management of accounts receivable. Calculate the size of overdraft of FLG company, the net working capital of the company, and certain other things are also given. So this is a question which is about working capital. So various aspects are looked into. So let's take it up and then work out this question. The first one, you also have to participate, Ashley. Someone else,
Yes, ma'am.
Manit has joined. Okay. It says that what are the key factors which determine the level of investment in current assets? So now, current assets are basically useful for meeting their operating expenses and discharging their liabilities. So that is the purpose. That is what we understand there. So now we see that there is an operating cycle. Operating cycle wherein cash, we see cash is invested in raw material. Then raw material gets converted to finished goods. Then we see that finished goods are sold, accounts receivable. Then we see and then accounts receivable is paid off, and then we see that the cash is realized. Okay. Now, why are they investing into the current asset? The question says that key factors which determine the level of investment. So, how much is the level of investment in current assets? Is what is that? Which the question is asking. So, how much should be invested? So the first one point what we can talk about is if the operating cycle is short, so few less amount of investment is needed. But if the length of the operating cycle is longer, it takes longer period of time for the investment to be converted into cash. Then they have to invest more amount into current assets, because when they are converted back into cash, this cash will be used for repaying the current liabilities and also meet their operating expenses. So if they invest some amount and that gets blocked in the current assets only, it is there in the inventory form, it is there in the finished goods form, or credit period to the customers is given for a longer period of time, then they need cash for other purposes also. So they need to have more amount of cash, more amount of investments into uh, current assets. So one factor we can talk about is, so we are answering a bit. Okay, so the first point what we can talk about is what is the length of the operating cycle. The second one, okay, from this operating cycle only you think about and tell me about what could be another one from this only operating cycle. Manit and Ashley, two of you are there. Please participate.
How much, how much credit days we allow to our customer, that also uh, affects our operating cycle.
Okay, credit policy. Very good. Okay, what is the credit policy? Is it a relaxed credit policy, longer period of credit terms are given, credit period is extended, or they have a shorter period of that? Okay, very good. Okay, any other point?
Ma'am, similarly, the credit period that we get from our suppliers, like in how many days we have to pay our suppliers, that
Okay,
also.
okay. Credit period extended by suppliers. Next, how much inventory should they hold it? Some of the industries, they have inventory, some amount of minimum inventory which they all the time have to hold it as a minimum closing stock or minimum balance of inventory. So something related to inventory policies also have to take um, inventory levels which have to be maintained. Okay, by nature, some of the industries we see that the production process itself is a longer period of time. Heavy industries and all, we see that the production itself takes a longer period of time. So we see very specifically, if we are talking about the production time. Okay, but then production time, all these things are part of the length of the operating cycle. Therefore, from this we can elaborate. Maybe sometimes some of the businesses itself they require shorter period of time or sometimes longer period of time. Like suppose if we are talking about a service industry they hardly invest anything into inventory. Everything will be in form of services rendered. Amount is collected. At the most they may have accounts receivable. So then we see that the length of the operating cycle is small, but for a manufacturing business, manufacturing of sometimes the manufacturing goes on into months and years also. So more than 1 year also it may take. So in such a case, we see that it depends on the nature of the business or the type of industry. Okay, so we can also quote it as type of industry. Okay, nature of business, nature of production, whether it belongs to the service industry or the manufacturing industry. So like that you can quote some of them, discuss the key features. Because it's 4 marks, at least you should touch upon 4 points because it's a 4 marks question. Okay, then we see the second question is briefly discuss the ways in which factoring can assist in the management of accounts receivable. So any points about factoring which you can talk about? What is factoring? Factoring is a financial service extended by a third party called as factor. So we know that financial service. The question asked is, now we need not explain about what is factoring and all. For our information, we have to know. Then how do we write that? Briefly discuss the ways in which factoring can assist the management of accounts receivable. How can it assist the management? Okay, because of a factor, they would be able to meet their liquidity requirements. Okay, factoring helps to meet the liquidity requirements. Then anything else? Because factor is giving at least 80% of the amount to the seller, so seller will have the cash available with him and then he can meet his other requirements. Then anything else which you can think? Yes.
There can be less chances of irrecoverable debts because factory is going to pay the company.
That is if it is without recourse. So if it is without recourse, mm, but if it is with recourse, the uncollectible amounts are again transferred back to the seller. So that point we have to be careful. Only if it is without recourse. But then when the terms are without recourse, the seller will have to pay a higher amount of finance charges to the factor. So those are the terms and conditions. It's not always that the factor will be taking up the risk of bad debts. So bad debts are taken by the factor if it is without recourse. If it is with recourse, the uncollectibles will be transferred back to the seller only will have to bear that. Okay, okay. Helpful in case of managing bad debt risk. by factoring without recourse. Okay, then because there is a factor to provide that, okay, the credit policies can be taken by the seller to increase the sales. Okay, increase in sales is possible on account of relaxed credit policy. Okay, buyer also can assist the management in terms of accounts receivable. So factor collects the dues from the buyer on the due date. Okay, anything else? It's a 3 marks question, so at least 3 points you should write. Then comes C bit. Calculate the size of the overdraft of FLG company, the net working capital of the company, and the total cost of financing its current assets. So we are asked to find out about what is the size of the overdraft of FLG company. Okay, let's look into this one. What do we have? We have annual credit sales of 4.2 million, cost of sales of 1.89 million, current assets consist of inventory and accounts receivable, current liabilities consist of accounts payable and an overdraft with an average interest rate of 7% per annum. The company gives 2 months credit to its customers and is allowed on average 1 month credit by trade suppliers. It has an operating cycle of 3 months. Current ratio is given. Cost of long-term finance of FLG company is given. So now here, if we have to find out okay, the current ratio is given to us. It's roughly presented here. If the balance sheet is there, on the balance sheet side, they mention that current assets have only two items. What are those two items? They are accounts receivable and inventory. Accounts receivable, and then we have inventory. On the current liability side, they also have mentioned that they have accounts payable and overdraft. Do we know any of these items? Accounts payable and overdraft, and the question is asking us to find out what is the size of the overdraft. So here in this case, how do we proceed further? We need to know what is the amount of accounts receivable, we need to know what is the amount of inventory. Okay, um, the accounts payable, all these things, when we know, when we will be able to understand what is the size of the um, overdraft, the net working capital of the company, and the total cost of financing its current assets. Any clue as to how do we proceed further? See,
Yes, ma'am.
yeah,
Ma'am, since we are given that the operating cycle is of 3 months, and we know that operating
very good,
cycle is
very good.
equal.
That's the clue. Okay, that's the clue. So let's start with that. Okay, operating cycle. Operating cycle is equal to, the formula for operating cycle is equal to the number of days of accounts receivable days plus the inventory days minus the accounts payable days. Okay. We see operating cycle is of 3 months. Everything is given in months only. The company gives 2 months credit to its customers and is allowed on average 1 month credit to trade suppliers. So receivables, we have the number of months. The payables also, we have it as number of months. Operating cycle is also given as number of months. So all of them are in terms of months. So operating cycle consists of 3 months. So 3 months is equal to accounts receivable days are how many days? The company gives 2 months credit to its customers. So 2 months is the accounts receivable days plus the inventory period. Inventory period, let's put it as period, minus accounts payable period. Accounts payable is given as they are extending 1 month. So in that case, we see inventory period. Inventory period is equal to um, 4 minus 2, 3 minus 2 plus 1, which is equal to 2 months. After that, we have to elaborate on what is the formula of inventory period. So inventory period is equal to the formula for inventory period is equal to, since everything is mentioned in terms of months, we have it as 12 months divided by inventory turnover ratio. So if it is inventory turnover ratio, we can just write this. Inventory turnover ratio can be written as 12 divided by, in a bracket, inventory turnover ratio, the formula is cost of sales divided by inventory. That is the formula. The cost of sales part of it is known to us. Value is 2 months. Then 2 is equal to, now this entire thing 2 months is equal to this one. So take 2 to the other side and cost of sales by inventory comes this side. So we have cost of sales divided by inventory is equal to 2 comes to this side. So 12 divided by 2, which is equal to 6 times. Okay. Then we see cost of sales is given as 1.89. So inventory is equal to, inventory is equal to 6 into only, no, this goes to, no, 1.89, I'm really sorry, 1.89 divided by 6, uh, which is equal to, how much is it? Calculation is equal to 1.89 divided by 6. So we have the 0.315 million. Okay, so we could find out what is inventory. So inventory part of it is calculated. Now we have to look at how to calculate accounts receivable, because the credit periods are given for both the accounts receivable and also the payables. The periods are mentioned to us. So in a similar fashion, we also work it out with the accounts receivable and the accounts payable periods. Okay, let's start. Now accounts receivable period is equal to 2 months. Okay, is equal to 12 months divided by accounts receivable turnover is equal to 2 months. Okay, so now we see that 2 months accounts receivable turnover is equal to 12 divided by 2, which is equal to 6 times. Then, but the formula for accounts receivable turnover is we have in the numerator. What do we have in the numerator? What's the formula? What do we have in the numerator?
Credit sale.
Credit sales. Okay. So credit sales divided by turnover is always there in the numerator. So we have it, credit sales in the numerator. Denominator we have accounts receivable. So credit sales are 4.2 million divided by accounts receivable is equal to 6 times. So accounts receivable is equal to equal to 4.2 divided by 6. So we have it as 0.7 million. A similar note, we also find out what is accounts payable period. Accounts payable period is equal to the period is given as 1 month for payables. The formula for that is 12 months divided by accounts payable turnover is equal to 1 month. Now, what is accounts payable turnover is equal to 12 divided by 1, which is equal to 12 times. Name the formula for accounts payable turnover. What do we have in the numerator? The numerator has cost of sales. Okay, cost of sales divided by accounts payable. So we have it as cost of sales, which is 1.89, isn't it? 1.89 1.89 divided by accounts payable is equal to 12. So now accounts payable is equal to 1.89 divided by 12. So this is equal to we have 0.1575. Okay, these are all in terms of million. Can we find out what is the size of the overdraft if we are putting a balance sheet or a working capital thing? So we can find out what is overdraft. There is something else also which is mentioned.
Current ratio.
That's right. We also have the current ratio mentioned to us. So depending on the current ratio, because the uh, terms given are the current liabilities consist of only two items, current assets also consists of only two items. So the total of current assets, because both the items we know, accounts receivable we know the inventory part. Then for the accounts payable, we do not know what is overdraft. So on one side of that, we know what is the total amount of current assets. So current ratio is given as 1.4 times. So start with current ratio. Current ratio is equal to current assets divided by current liabilities, which is equal to, it's given as, the value is given as 1.4. We also know what is the total of current assets. Current assets are only two items, which is inventory and accounts receivable. Inventory, inventory we got it as 0.315, accounts receivable we got it as 0.7. So here we would take it as current assets are 0.315 plus 0.7 divided by, we have current liabilities, is equal to 1.4. So current liabilities is equal to, the total will be 1.15, I guess. 1.15 divided by 1.4. 1.15 divided by 1.4, which is equal to, we got it as 0.725 million. Okay, 0.725 million. Then current liabilities is equal to, it consists of two items. Current liabilities is equal to accounts payable plus overdraft. Now this is equal to 0.725. We already know what is current accounts payable, which is equal to 0.1575. So overdraft is equal to, it goes to the other side, 0.725 minus 0.1575. So this is equal to 0.5675 million. Everywhere, wherever it is there, you have to mention million. Okay. Done. After that, the same question number C talks about what is the size of overdraft, what is net working capital. Can we find out now what is net working capital? Because we know current assets, we know current liabilities, we can find out. So then the third part of it says what is the cost of financing its current assets. Okay, so let's see. Net working capital, start with net working capital is equal to current assets minus current liabilities. So we know what are current assets and current liabilities. I'll put it here only. um, is equal to current assets total, where is it, current assets we have 0.315 plus 0.00. So this is equal to 1.1 1.015, I guess. Isn't it? Am I right?
Yes, ma'am.
Minus we have the current liabilities as 0.725. Is it 0.29 million? Did you get the same thing? After that, what is cost of financing its? What is it? Cost of financing its current assets. Cost of financing its current assets is what is given. Okay. Um, The question says that current assets consist of inventory and current liabilities consist of accounts payable and overdraft. Overdraft has an interest rate of 7% per annum. That is one point. The second one, the company gives 2 months credit. These details are given. Other relevant information is current assets of FLG company is 1.4 and cost of long-term finance is given as 11%. So we look when we look at that, we understand that there are two different rates or costs which are calculated. One is as a short-term rate and then another one is a long-term rate. So that is what is given to us. So if this is what we are looking into, we have to understand that see, current assets is equal to current assets is more than the current liabilities. We understand that current ratio is 1.4, which means that as much as the current liabilities are there, more than that is the current assets. So if current assets have to be invested, it is not sufficient that only the current liabilities are used. Some part of the long term liabilities also will be needed because current assets are more than the current liabilities. So if the short term interest rate which is paid is on the current liabilities, but current liabilities alone are not sufficient to be invested into current assets. So that's one point. So they also have to take care of the long term liabilities and make a payment for the long term finance cost. Fine. So both the rates would be applicable here. Both the rates would be applicable. So from the calculations what we have taken up just now, when we look at that, okay. The concept of investment into current assets, because current assets are more than the current liabilities. So as much as the current liabilities are, the current liabilities will be used to invest into current assets. But because the ratio itself is 1.4, one time is about current assets, but excess is there. By how much is that excess? That excess amount will be invested with long term liability. That's the concept. Okay. How much is the excess? Because we have already calculated the excess amount of current assets over current liabilities, and we are calling it as net working capital. Since the net working capital is known to us, we know how much extra is the amount as much as the current liability. So we know what are the current liabilities. The total of current liabilities is known. Now the short-term interest rate, on an average interest rate of 7%. So which means that, so that's the prevailing interest rate for the short term. So OD is also paid at a rate of 7%. So the short-term credit is at the rate of 7%. The long term credit rate is also mentioned to us, that is 11%. But how much amount is taken from long term sources is 29.29 million. Do you see that? Because current assets are more than the current liabilities by 0.29. So take that part of it and calculate cost of finance. I hope the logic is clear to you. Current assets are more than the current liabilities. By how much? We see that by how much part of it, it says that by 20.29 million. By 0.29 million, it is more than the current liabilities. So all current liabilities which are raised are invested into current assets. So how much are current liabilities? That also we have calculated, which is 0.725. Okay, out of the this, because the credit facility is given by the supplier. Okay, because the credit facility is given by the supplier, there is no cost of interest paid to the accounts payable. Only the payment which is made is on the overdraft. And from 0.725, because the accounts payable has no cost, there is no charge, it's only a credit facility extended by the supplier. We do not have to consider the entire amount of 0.725, but very particularly focus on the one on which they are paying an interest rate of 7%. So OD is paid at an average interest rate of 7%. So OD is 0.5675, interest rate is 7%. Okay, then more than the current liabilities, how much is that? Is working capital 20.29 million. On 0.29 million, 11% will be calculated. I hope I made it clear. Did you understand?
Yes, ma'am.
OD, we got the value. OD value is 0.5675 into the rate is 7% per annum, which is equal to, then cost of long term liabilities is equal to, long term liabilities are um, 0.29 into 11 only, no, 11%, which is equal to, all of them are in million. No. So which bit we have finished? We finished doing the C bit. Okay. So all of them have done. Size of the overdraft, we got it. We got it, net working capital. We also got what is the total cost of financing its current assets. Unless and until the logic is there inbuilt in your mind, it is not possible to proceed further. But very good answering, Ashley. You are able to get the logic behind it. So to begin with, absolutely it was blank, nothing was there. So when we take some time and read through the question, then we get to understand what's the logic. Straight away, see, after two theory questions they have asked us to find out what is the cost of the over I'm really sorry. What is the size of the overdraft is what is asked. How do we understand what is size of the overdraft? Just um, roughly draw a balance sheet and then write what are there on current assets, what are there on current liabilities. And if these are the four items, out of that, if one unknown variable overdraft is what is asked to be calculated, we should definitely for sure know the other three variables. Once we know the other three variables, we will be able to calculate what is the fourth variable. So looking at that, so what else is the information? Then again read through the first paragraph. And because the periods are given and the total period of the operating cycle is also given, we have cracked that part of it and then proceeded further, and it was in the same fashion, same direction which we have went ahead. Then that has resulted in finding out what is overdraft. We have calculated what is working capital. Then we also have calculated what is the cost of financing its current assets. The cost of short term assets is there, the cost of financing overdraft is there, cost of financing long term liabilities is also there. Okay. Debit. Okay. FLG company wishes to minimize its inventory cost. Annual demand for a raw material costing $12 per unit is 60,000 units per year. Inventory management costs for this raw materials are as follows. We have ordering cost, holding cost given. The supplier of this raw material has offered a bulk purchase discount of 1% for orders of 10,000 units or more. If bulk purchase orders are made regularly, it is expected that the annual holding cost for this raw material will increase to $2 per unit per year. Now, what is required? First bit under D, it says that calculate the total cost of inventory for the raw material when using the economic order quantity. So EOQ is what we have to find out. So what's the formula for EOQ? Under root 2 CO divided by I. Basically 2 into annual demand into ordering cost per order divided by carrying cost per unit per year. That is the formula of EOQ. So we need to see what whether the variables are present or not. Do we see what is the annual demand? How much is annual demand?
60,000 units.
1,000 units. Okay. Ordering cost per order,
6 per order.
per order. Then we see what is the holding cost or the carrying cost per unit per year is given as 0.5. So simply substitute these things and calculate what is EOQ. We are doing debit. Under debit, we are solving first small bit.
1,200.
So you already got the answer. How much is that?
1,200 units.
Okay. 1,200 units. Good. After this, that's 4 marks. Calculating the EOQ is for 4 marks. Determine whether accepting the discount offered by the supplier will minimize the total cost of inventory for the raw material. So there are certain terms which are given for availing the discount. What are those terms? The supplier of this raw material has offered a bulk purchase discount of 1% for orders of 10,000 units or more. So if the order is purchased as 10,000 units or more, they can avail a discount of 1%. At present, how much are they purchasing? They're purchasing for the annual demand, which is 60,000 units per year. Then, if the bulk purchase orders are made regularly, it is expected that annual holding cost of this raw material will increase to $2 per unit. So, whether or not to avail this um, discount is what has to be looked into. Fine. Um, no, the annual requirement is 60,000. Um, the annually the requirement is 60,000. If they purchase at a time 10,000 units or more, they can avail a discount of 1%. That is what is mentioned. Okay, just give me 1 minute. Okay, sorry about it. So they require annually 60,000 units. So, but then if they purchase 10,000 units at a time, now a discount can be availed. But at present, annually requirement is 60,000. But how many are they purchasing at a time is what we have to look into. At a time, how many units are they purchasing? So, um, how many units are they purchasing? It says that this is how we understand that. So how many units are they purchasing is by way of calculating the EOQ. So which means that every order which they purchase, they would purchase it at 2 into 6 into 60,000 divided by 0.5. Now at present they are only purchasing at 1,200 units every order. That is what is EOQ. The order which is purchased, which is also economical in nature. So if they are buying at 1,200 units per order, it is economical for them. But apart from that, there is also an offer that the as the supplier says, the supplier of this raw material has offered a bulk bulk purchase order of 1% discount. So discount is given as 1% for orders of 10,000 units or more. But now they are purchasing only 1,200 units per order. So now we have to find out what is the cost if they are purchasing 1,200 units at a time, or what is the cost if they are purchasing 10,000 units at a time. Okay, second bit. We are looking at second bit. Cost present and the offer of the supplier. So let's take two columns. One is for 1200 units. Another one would be 10,000 units. So because that's the offer of the supplier. So two columns let's take 1200 units one thing and 10,000 units. Annual requirement is 6,000 units. So 60,000 units we know that. So if 60,000 units have to be placed in an order, by placing 1200 units at a time, how many orders will be required? Number of orders is equal to, here it will be 60,000 divided by 1200. So that many number of orders they would place. 50 orders. If it is only 10,000, we understand it would be only 60,000 divided by 10,000. It's only 6 orders they will place. So the ordering cost will be, what will be the ordering cost? Ordering cost is 6 per unit, isn't it? So here it will be 6 into 50. Then here it will be is equal to 6 into, how many orders are they placing? Only 6 orders they are placing. So it would be 36. So one is 50, another one is 36. Okay. Then holding cost. We need to find out holding cost. What is holding cost? Holding cost is mentioned as 0.5 per unit per annum. Holding cost is 0.5 per unit per annum. That is what is given. So when we are calculating holding cost, holding cost is always calculated on average inventory. The reason is inventory is not the same all through the year. At the beginning of the year, there is nothing. Then inventory is purchased and issued, purchased and issued. At the end of the period, we see some amount of closing stock. Beginning of the period was some amount of it. We do not see that uniformly it is the same amount of inventory throughout the year. So generally, on what value should holding cost be calculated? On that note, we always see that it is the average cost. So average cost is beginning plus ending divided by 2. So beginning we do not know, so ending we have, so beginning plus ending divided by 2. So the average inventory, the inventory which is required, which is 60,000 per annum, we make it as on an average, the on an average, how much would it be? So now the inventory order which is purchased, they are purchasing it as 1200 at one given point of time. So maybe I'll put it in another manner. So the first case they are purchasing. So totally 60,000 is needed, but all 60,000 they are not buying it at one time. In the first case, they are buying it as 1200. So let's say if this is the level of inventory at zero number of units, they do not have anything. Suddenly they buy 1200 units. So when 1200 units are purchased, then they are there in the stores department. As they are issued to the production department, we see it keeps decreasing. Okay, so at any given point of time, we do not see the same amount of inventory level. At the beginning, it is zero, then it is 1200, then when it keeps decreasing, then again they place an order. By the time it reaches zero, again 1200 comes. So we see that is the cycle which goes on. Same is the case with 10,000 units. So when they have zero number of units, they make a purchase for 10,000 units, and then as the number of units are issued, then it keeps decreasing. Before it touches zero, again another order will be placed. So that's the logic here. So because we see that one level it is zero, another level it is the maximum amount, and in between we have the decreased level. So here generally whenever holding cost is calculated, it is always calculated as an average cost. So holding cost should be taken as, I'm putting it here, take the inventory. How much are they purchasing at one time? 1200. 1200 divided by 2. Then that makes it as average inventory. On the average inventory, apply the rate. What is the rate? The rate is given as 0.5 per unit per year. So 0.5. Okay. Okay. Then here it is. At a time, 10,000 units are purchased. Um, Divided by 2, that makes it as average inventory, then into 0.5. Okay, in both the cases cost of material will be same. It is no different. Cost of material is, they require 60,000 into each unit cost is something is given. Raw material costing $12 per unit is 60,000 units. So it is 60,000. So it doesn't matter whether it is this side or that side. Every year, every situation, it is only 60,000 units. Here also we see that it is equal to 60,000 into 12. Okay. Just add all the three costs. We have 7,20,600, 7,22,536. So in spite, okay, now discount is given in case of this one. I'm really sorry, I didn't apply the discount part of it. What's the discount? What's the discount? Discount is 1%. 1% is the discount. So if 1% is eliminated, there would be 99%. Is my calculations correct?
Yes, ma'am.
Okay. So is it beneficial?
Yes.
Okay. Everything is correct, no? Discount also, the cost of material into discount of 1%, so they would be paying only 99% of the total cost. So this is the cost of material. Holding cost, average inventory 10,000 divided by 2 into 0.5. No. It is expected that the annual holding cost for this raw material will increase to $2 per unit per year. So here in this case, it will be $2. Check check this once again. Um, The supplier of this raw material has offered a bulk purchase discount of 1% for orders of 10,000 units or more. If bulk purchase orders are made regularly, it is expected that annual holding cost for this raw material will increase to $2 per unit per year. Calculate the total cost of inventory for the raw material. Determine whether it accepting it or not. So the logic is the same, but there are one or two points which have differed. The order is 60,000, average will be taken on the ebook, the order size. So 1200 holding cost will become 1200 divided by 2 into 0.5, and for this one it will be 10,000 divided by 2 into, it is holding cost is not 0.5, but it is 2. Why do you think it increases? Because more amount of material, more storage cost would be incurred. That reason, for that reason, the holding cost increase. Okay, done. So this is a 20 marks case. I will take you through another 20 marks case from working capital. So we will have one day for tomorrow if we do this. Tomorrow is Friday. One more day we have for investment appraisal. One case we can look at.